Good morning from London. I'm Guy Johnson alongside Kriti Gupta. We're an hour away from the opening trade here in Europe. So what do you need to know? There has been aggressive selling in Asian equities overnight. The Nikkei is about to close down 12.5%. European futures, US futures are also sharply lower. Treasuries, on the other hand, are surging. Investors are now positioning for the Fed to deliver circa 115 basis points of cuts before the year end. Crypto is getting crushed. Elsewhere, Israel is on high alert. The country is bracing for retaliation from Hezbollah and Iran. Axios is reporting the attack could come within hours, Kriti. But the market story this morning, sensational.
And you're already seeing that early on in the futures trade. You mentioned the U.S. futures. Let's take a look at your Stoxx 50 futures, down 2.4%. If we look across the Atlantic, the NASDAQ 100 is taking a beating as well. And it's only been the overnight traders down almost 5.7% there. Dollar yen, of course, really at the core of this trade, this FX trade that's unwinding. 142 handle when you look at that currency pair. And you are actually seeing, well, oil is not the right thing. They're lower. Posted on the board, but what you need to know is that oil is lower as well, a 76 handle, given all the geopolitical risk sentiment outweighing the risk of war. Now the countdown to the opening trade starts right now.
Monday the 5th. Good morning. I hope you had a nice weekend. I hope you enjoyed the Olympics. That was the weekend. This is Monday. And I have to say, folks, it is looking ugly out there. Asian equities have been selling off aggressively, as Kriti's just been pointing out. We'll get further updates in just a moment. The Nikkei has been under significant pressure. The yen has been rising. Here in Europe, it looks like we're going to see an ugly open as well. In the United States, it looks like we are going to see maybe a drop of 3% circa on the S&P. NASDAQ futures are down circa 6%. Kriti, for Asia at least, it's looking like a Black Monday.
Well, we're about halfway there to what a Black Monday was. I think you had us Google this, a 23% drop back in 1987. But we're headed in that direction, for sure. This is the perfect storm when it comes to what's driving these markets. Because you're seeing it not just in the stock market, you're seeing it in this bond market. The bid for bonds right now is wild. The fact that we're at a 371 on the 10-year, I don't think I could have predicted that.
Look at the front end. Look at what's happening there. The market is now pricing in, let's call it circa 115 basis points of cuts from the Fed, i.e. we're going to get some 50 basis point cuts out of the Fed. Is the Fed really going to react that aggressively? Was the data on Friday really that bad? Friday feels like a long time ago. That print on the non-farm payroll number was ugly, but it wasn't that ugly. And the market is reacting really badly to it.
Well, it's a renormalization. I thought this was really interesting when we're talking about it. Coming at 114,000 to refresh everyone's memory here. The whisper number, the expectation was somewhere 200,000. In a post-COVID normal, 200,000 is kind of the average of what we've seen until Friday. I think the folks over at Goldman Sachs made a really good point when it comes to that, yes, there are certain cuts that are now priced in, and you're going to see it in the markets. But the folks at Goldman saying, well, maybe this was just one print. Maybe you are actually seeing folks kind of come back in as well and have more jobs, because the JOLTS data, the openings data, still suggests that there is solid demand. So they're saying this is the one-time thing.
We're going to see services ISM a little bit later on. That'll be an interesting data point. Will that confirm maybe that the Fed needs to step in and deliver something? Do we think that the Fed is really going to be riding to the rescue this time around? Is it going to be riding to the rescue in the way that it has in the past? Are we really going to see this? The bond market has really called the Fed wrong recently.
Why would it not, is my question. Does it have any other choice but to ride to the rescue?
Does it need to rescue the markets? If the economy is looking okay, if the economy is slowing down gradually, but the markets take a plunge, does the Fed feel that it needs to support the markets, I guess is the question I'm really asking.
Well, I guess the argument to do that is that the market reaction would be a function of some sort of sign that a recession is around the corner. So they really be, in theory, responding to that recessionary impulse in the main economy. But to your point, this is where you need to see what the impact is on financial conditions. There's where you need to see how much of the pain that you're seeing in the stock market actually shows up in some of the ingredients that you see that make up what the Fed is going to keep an eye on. And that's just, again, what we're seeing in the States. Then you have the entire story of what's going on in Asia as well. Let's just get a recap of the pain that we're seeing there. Avril Honk been covering that story all morning. Avril, walk us through the carnage we're seeing.
Carnage, bloodletting, panic, mania, just some of the words that have been used to describe the rout in Japanese as well as Asian equities today. We're seeing the topics, the Nikkei closed down 12%, 25% off from the peaks that we saw in July. On the topics, this is the worst day since 1987 for Japanese equities, the worst 3-day rout on record. I can throw more superlatives at you, but important also to rake through what is happening and driving these extreme moves in the market, the unwinding of the carry trade, the strengthening in the Japanese currency, now moving towards that 142 level against the greenback, but also this fear that not only has potentially the BOJ but the Federal Reserve gotten things wrong. Maybe the BOJ has gotten too aggressive and the Fed not aggressive enough when it comes to easing, and then throw in, given how we're seeing these extreme levels of selling, what we're seeing might be these retail investors being forced to sell, given how they've bought some of these stocks on margin. So this is what we're seeing cross assets in Japan. But flip the board, I want to talk you through what we're seeing the rest of the region, because the pain has really spread. Asia's stock gauge just about erasing all its gains for the year. And if you think about how this has mostly been driven by the tech sector, it is unsurprising that that is the sector, as we see these unwinds there, is getting hit the hardest, almost 10% down on MSCI Infotech. The TAIEX seeing its worst bleed on record. On a day like this, we've seen a number of these circuit breakers being triggered in Japan, in South Korea as well. And interesting to see how the bleed in Chinese equities is not as bad on a day like today, guys.
It's amazing, isn't it? Everyone, thank you very much indeed. Everyone Hong updating us on what has been a wild session out in Asia. Are we going to see similar sessions here in Europe and the United States? Doesn't look like it at the moment, but certainly futures are sharply lower on both sides of the Atlantic at the moment. I want to point out as well that we are seeing significant pressure on euro-dollar this morning. We haven't even talked about the fact that Buffett is unloading a big chunk of Apple stock as well. That's another factor affecting sentiment this morning. The other topic we should probably just mention as well is the geopolitics, because, Kriti, this could be something that is quite negative as well. Axios is reporting that we could see attacks within hours, potentially on Israel, coming out of Hezbollah, out of Lebanon, out of Iran, out of the Houthis potentially as well. Israel is braced for those attacks after the moves we saw last week by Israel. We need to factor in geopolitics. A wider war in the Middle East is something that investors are going to have to think about as well this morning.
I thought what was interesting is that from that investor standpoint, last week when we did see these retaliatory attacks, when we saw that assassination happen in Iranian territories, well, you saw oil actually react to it, which is the first time that I saw it actually be kind of see this 1.5%, almost 2% move in the oil market. Today, you were seeing the exact opposite. Even as geopolitical risk actually heightens, oil reacting more to that risk sentiment and the global sell-off. You're looking at a 75 handle on Brent, despite the fact that we are at almost that breaking point when it comes to the tensions in the Middle East.
It's interesting. We haven't actually seen that much of a reaction in gold this morning, which I think is interesting, given the moves that we're seeing elsewhere in crypto. Gold only down by 0.5%. So basically, we've got equity markets selling off aggressively. You've got Treasuries, bonds broadly reasonably well bid this morning. We're going to run you through all of the price action. We're going to count you down towards the market open. There's going to be a lot to think about in Europe this morning. In terms of the guests that we've got covering this for you, Shri Kochavadan, a senior research economist at Aberdeen, is going to join us at 8 o'clock. We're going to get a view on the deepening stock route that we're seeing. Mueller-Glissman, head of asset allocation at Goldman Sachs, is going to be joining us 8:30. We're going to go back to what Kriti's just been talking about as well. We are going to have an update on what is happening with the commodities story out of Fitch. All of that coming up on the rest of the show. Plus, we'll be plugging in, of course, all of the fantastic Bloomberg coverage of this route that we are seeing and making sure that you're up to speed as we approach the European Open and then take you towards the US Open a little bit later on.
And speaking of the US Open, S&P futures now hitting that 3% level, following in the carnage that you're seeing across the world, also in those NASDAQ futures. So in addition to the market moves, we also have a couple of things that are going to monitor. Guy mentioned this. We have the ISM services numbers coming out today, plus right here in Europe, those PPI numbers as well. But then we have that earnings story that continues. The likes of Saudi Aramco, Bayer, Airbnb, Uber, Reddit, IHG. There's plenty going on these earnings stories. So there's a lot going on then when it comes to factoring how much of this is macro risk sentiment, how much of this has actually to do with the individual fundamentals of these companies. On Wednesday, of course, we've got the German industrial production. Do we continue to see that weakness in Europe, and really driven by the German story as well? And then the earnings story continues on Wednesday. Disney, SoftBank, Novo Nordisk. I think, Guy, what you really need to know is that there's plenty going on earnings related all week long, some major companies, and yet it might not even matter, because at the end of the day, it feels like this macro sell-off is what everyone's watching.
Unless the earnings are bad. If the earnings kind of exacerbate the theme, then it's going to be one other factor into the mix as well. If these earnings don't deliver, then that's going to be potentially something that people are going to want to factor in to this move on the downside.
Is that priced in, though? I'm curious. I wonder if you see the sell-off now and the earnings come in lower. Is that a buy the dip moment?
I think they probably are, but it's not a force to reverse it. It's not a force to think, you know what, actually the economy's in okay shape, the corporate landscape is in okay shape, the data are probably going to be in okay shape as well. It's just one other factor you need to think about in terms of sort of plugging into the model and thinking about kind of, are we mispriced? Are we still mispriced? How much further downside could there be? I don't know. It's going to be, I think the earnings story are, maybe to your point, going to play second fiddle this week, but I think they are going to be still on the stage and important in terms of what they're going to be telling us.
Well, speaking of some of the other things to kind of factor into the Rolodex, you mentioned geopolitics at the very start of the program. There's a couple of other stories from around the world that we're following, starting right here in the UK, where Prime Minister Keir Starmer has called for an emergency security meeting today in a bid to quell anti-immigrant protests across the country. He said those responsible will be punished for what he described as, quote, far-right thuggery. Over in Ukraine, President Volodymyr Zelenskiy hailed a new era for the country as he showcased a pair of F-16s flying near Kiev, reiterating the call for more advanced air defense systems. And over in the States, Vice President Kamala Harris is said to have met with possible running mates. Sources say Harris met with Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz. A lot going on. Coming up, we are going to have more on German chipmaker Infineon reports an earnings miss. We'll take a close look at the numbers and discuss the wider pressures weighing on tech.
Up next, the global market meltdown deepens. We're going to continue to discuss what is happening here. S&P fair value down by 2.5%. Looks like the Nasdaq is going to take a battering. Tech stocks have been hit hard over in Asia. You want to join the conversation, please join the conversation. I can see already some notes coming through from you guys out there talking about what's happening with the oil story, talking about what's happening in terms of the pricing of the bond market. IB plus BBTV Go. BBTV Go is the function. We look forward for hearing from you. It's going to be a busy morning. This is Bloomberg.
We'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way.
Chicago's Austin Goolsbee, we are not going to overreact. We are going to take our time. We are going to have cool heads, and we are going to do the right thing at the Federal Reserve. The bond market is certainly overreacting. Is it? Is it not? That's what it certainly looks like this morning. You've got potentially 50 basis point cuts now being priced into the market. Kriti, we are getting a big reaction. We've now got, 115 basis points priced, circa 115 basis point priced in terms of the cuts that we're now seeing priced. The bond market has really struggled and has overreacted both ways throughout this year. Is this just a continuation of that process?
I don't know, but what I do know is that these numbers are scary. When you look at a bond market reaction like this, the momentum matters more than the end levels, and the drop that we have seen in these yields is incredibly scary, to the point that I'm looking at a 2s10s, by the way, that's only inverted by 3 basis points. That is wild to me. And the fact that we're looking now at 369 on the 10-year, we just broke into past 370. Massive when it comes to, you talked about the pricing of the, what do you say, 115?
I think it's circa 115, something like that.
Something along those lines.
But it means we're getting 50 basis point cuts.
It's a lot, 100%. But I'm curious what that means for the bond bulls. Is this where you hop in and you say, we're getting on this train, we're seeing a 10-year at 3.5%. Who won in this trade is more of my question.
I don't know, and it's difficult to tell at this point. There is definitely you've got a market that has got very stretched, and as a result of which you are going to see kind of an opposite reaction to that. And there's some positioning stories around in various asset classes this morning. The bond market is not immune to that story either, but the market is clearly taking a very big risk-off kind of story, which is probably overemphasizing how much the Fed in reality is going to do. Market pricing is not necessarily telling us exactly. There's not a straight line between market pricing this morning and I think where the Fed is going to be.
Well, let's see if someone can draw that line for us. Joining us now, Sri Kochu Govindan. I'm going to say that very slowly. Senior research economist over at Aberdeen joins us this morning. Look, Guy and I are drinking out of a fire hose this morning. I think everyone kind of is in terms of these market moves. Well, let's start with the bond market here. 115 basis points priced in for the Federal Reserve. You're seeing banks across Wall Street actually increase their odds of recession. What are they responding to? What is the red flag here?
I think what we've seen is just in the last week or so, it's been a bit of a perfect storm in terms of US data, but also central bank reaction as well, and central bank speak. So in terms of the US data, it is one data point here that we are reacting to. So we need to be a little bit careful in terms of interpreting these market moves. But then we did also see the breakdown of the ISMs, which were weaker. The employment component was weaker in the ISM and PMIs. ADP was a bit weaker in claims as well. So putting that all together, it does look like, a recessionary signal. However, if you take into account the fact that there is a little bit of a weather impact here in terms of Hurricane Beryl, if we look at, the seasonal impact in the household survey, that could be a feature here. There were some temporary layoffs, perhaps, at play here, pushing up that unemployment rate. But we were expecting a loosening of the labour market, and that's something that was needed in order to deal with the inflation issues that the Fed had been fighting. So
isn't that what's happening, though, Sri?
Yes.
Isn't this a normalization of a trend when pre-COVID, a 200,000 print was considered too much, and now that's what we need?
Yes, exactly. So this is a disappointment versus consensus versus expectations. However, I think it'll be interesting to see. We've still got a little way to go before the next Fed. So we've got another payrolls report, a couple of inflation reports as well. All of that will be featuring in the discussion and the market narrative. We have Jackson Hole coming up this month. All of these will be key, but it does look like quite a big jerk reaction and perhaps positioning as well in some of these. And some of the moves, particularly in the yen, is, again, signalling that position, stretch positionings, pulling back as well.
Just reading a Deutsche Bank notes just dropped into my inbox. San Francisco Fed analysis pointing to a potential weather-related drag of 15,000 to 35,000 in July. When we start factoring the weather in, it starts to get really difficult to kind of manage these numbers.
Yes.
You're getting a big reaction. Does the reaction start to become self-fulfilling, though? That's my question this morning. And you start to see, as Kriti was pointing out earlier, financial conditions being affected. You start to see that drop in asset prices maybe affecting Fed thinking. Would a big move, market move, necessarily affect how quickly the Fed is likely to deliver the cuts we're anticipating?
Well, that's the risk here. And that's what some of the sentiment is shifting towards. There is talk about whether September is a guarantee, seems to be a guarantee at the moment, given the data and given the communication last week. The fear is, do they go 50 or do they have 3 cuts later this year? I mean, that's the debate at the moment. And really, if the Fed were to respond to markets, that would be a fear of the channel through to how it impacts consumers. If we look outside of the payrolls data, some of the activity data hasn't been that weak so far. So really, this impact of the wealth impact onto consumption, that takes a little bit of time to filter through. So for now, there is a risk, obviously, of 50 if the markets continue to, hemorrhage like this. However, we are looking. If we try and look through the noise within the one print, perhaps we can see a 25 in September and more, and then we'll wait and see how that's materialising.
So what is your gut feel this morning? Is this just a reaction to a piece of data that has caused a big move around the world, but a big move that was inevitable at some point? This is this is a positioning story, this is a leverage story, this is a stretch story. Is that what we're seeing this morning?
Yes, and we tend to see it's August as well. Early in August, I see there's some seasonality here. Volumes are thin, so that's part of the story. But positions were stretched. We saw some weak tech earnings as well. And I think there has been some fear about the impact of the yen trade and the carry-on wine story, and we're seeing that play through as well. I mean, the yen's been quite weak, not just against the dollar, against euro sterling as well. But we're also seeing, I think, fears of a spillover of the US recession. Euro area has not been that strong. There's been some weakness in the data there. China as well, not looking, the activity. We've had some stimulus there, but we're not seeing the big fiscal stimulus that we've seen in the past. So there are fears around perhaps there's a spillover in terms of global recession. I do believe that that's slightly overdone.
Yeah.
And we haven't seen enough in the data to really to really signal that just yet. But I think positioning, pullback was inevitable.
Well, speaking of that signal, what signal do we follow that? What is the kind of canary in the coal mine to say, okay, well, actually, the markets aren't overreacting. Maybe there is a recession down the road. If you look at, I'm looking at my obsession this morning was the 210s curve. We're almost going positive here, inverted only by about 2 basis points now. You also heard the Somm rule get triggered, the Taylor rule get triggered. Claudia Somm herself on Friday on Bloomberg said that, yes, it's triggered. No, it may not mean recession, even though that's exactly what the rule suggests. What is the signal we follow in an environment that we've never really had before?
Yes. It's true. It is a very different environment now. And I think, especially in considering valuations within equities and risk assets and the run-up that we've had, I think, again, the real signals will be within the labour market at the moment. We're seeing a disinflation trend well underway.
Yeah.
But now the focus has shifted away from services, inflation, wage growth. Now it's very much what is the underlying labour market dynamics. So those are the signals, I think, which will be really driving market moves going forward.
Well, the connection I can't figure out this morning is there is clearly a connection between the real economy and what is happening in markets, but has that connection become overly stretched? And therefore, can I divorce moves that I'm seeing in markets, which maybe are more normalising, back to what is happening with the real economy? And are the two starting to come with a big sell-off? Do we start to get back more aligned between those two factors?
So I'm curious to hear what Sri's take on this is, but this is, I think, that's more relevant perhaps to the U.S. economy than it is maybe to Europe or even to Asia, because the market reaction you see impacts 401ks, impacts risk sentiment. The wealth effect is far greater in the States as well. And that's why I think financial conditions matter so much for the Fed.
Absolutely. But have what I'm trying to work out is how quickly does that process unfold? We are anticipating that the economy is going to slow down. We are anticipating that we are going to be seeing a continuation of the data that we have been seeing, which has been pointing to a more normalised. It's just the market's recognising that process, and does it end there? Or to Kriti's point, does this start a spiral? Which I think is the bit that I can't. That's the jump that I can't make this morning, and I don't understand this morning.
I mean, the market seems to be moving in line with an imminent recession, which we're not seeing in the data at the moment. And the data is pointing towards a normalisation, not necessarily recession at this point. But there are obviously risks. And as you say, there is this feedback loop. I don't think the feedback loop is going to be filtering through into consumption so imminently. But you're right, sentiment is key. Sentiment within the markets and how that then starts to feed into people's consumer sentiment as they start to see their portfolio shrinking quite dramatically.
And these are the people that have been doing a lot of the spending as well. So it's been the upper quartiles of the American economy that have been spending the most. So you could argue in some ways that's where the consumer could get hit hardest.
I think it will take a bit of time to really filter through into consumption just yet. But in the meantime, a lot of volatility in the markets.
Sri, Kriti, thanks for stopping by to join us around the table. Sri Kojagovidan, Senior Research Economist at Aberdeen, thank you very much. Coming up, Buffett's been growing his cash pile. He's been selling Apple. We're going to talk about that story next. We need to fold that into our thinking this morning. It's clearly having an effect. We'll do that next. This is Bloomberg. Monday the 5th, good morning. 30 minutes to the start of trading here in Europe. To the opening trade, it looks like it's going to be a fairly difficult opening trade first thing this morning. Asian markets have been absolutely battered overnight. We've seen the Nikkei closing down very sharply. Other markets have been in a similar position as well. Doesn't look like that same sort of degree of extreme is going to extend into Europe, but you can see that we are down this morning. Futures on the Stoxx 50, Euro Stoxx 50 down by 2.5%. In terms of the bond market, clearly money is going to flow in that direction. It is a risk-off move this morning, and as you can see, we are bid on the bond market. As Kriti's been pointing out throughout most of the morning, we are getting back to a position where 2s, 10s in the States are fairly flat, so we have basically disinverted. The disinversion is usually when you start to get scared when you're in risk assets, because that signals maybe that recession that we've also been referencing. It could be just around the corner. Anyway, let's talk about some of the catalysts that we've been seeing and talk about the stock route that we are looking at this morning. Nasdaq futures are down in the States by around 6.5%. It was brutal in Asia overnight. One of the catalysts for that appears to have been news that Berkshire Hathaway has slashed its stake in Apple by almost a half. Its holding now stands at roughly $84 billion. That's down from around 140 at the end of March. And there's no reason to assume the Buffett is done just yet. The other factor that we need to fold into our thinking as well this morning is earnings season. We're seeing numbers out of Infineon, various companies, big companies reporting around the world this week. We need to factor that into our thinking as well. So let's digest all of this. We've got Daybreak anchor Tom McKenzie. We've got Tim Craighead, Director of Equity Research for Bloomberg Intelligence, joining us around the table. Tom, let's start with you. Did we see this one coming from Buffett? Did we only hint? I thought this was kind of one of his core holdings, one of his favourite holdings, but to see him selling in such a significant way.
And earlier this year, he talked about the importance of Apple and the role that that is playing. But this is still and remains its largest position. But you're absolutely right. This is a significant cut, around 50%, from 140 to 84 billion. They trimmed in May, by the way. We don't know why Warren Buffett and Berkshire Hathaway had made this move. We can speculate, and if you're looking for fear around every corner, then it ties into that narrative that he is seeing an economy in the US heading towards recession. Maybe he's also concerned about the exposure to China. We know he cut a position in TSMC, the foundry maker in Taiwan, back in 2022, and he talked about its location geopolitically. So maybe he's thinking about the politics as well. We don't know the rationale behind this. Others are saying, look, this is a natural adjustment in terms of the portfolio, a readjustment. This is about risk management. But certainly in a week and on a day when the markets are seeing the kind of bloodletting we're seeing right now, it adds to that concern. We'll wait to see if he says anything about that. He doesn't normally, but he's adjusted before. It still remains their biggest holding. They've had 900% upside since he took a position in Apple since 2016. 900%.
Tim, let me bring you into the story, because Buffett, it feels like, as usual, timed this market quite accurately, didn't he? And this isn't even going into his positions around Japanese banking as well. But from your perspective, we're seeing Nasdaq futures down 5% this morning. You're seeing the S&P 500 as of Friday's close down 6.5%. Is this normal? Is this just tech stocks taking a little bit of profit taking as Buffett is? Is it going to bounce right back? Your view?
So a couple of things come to mind. Number one, we do see this from time to time. And, you know, we've all been in the markets for a good long while. Interesting to see that we've got volatility, whether it's the VIX or the V2X, now back up to 24%. That's above where we were last August. So there's a lot of, fright in the market, if you want to think about it that way. It's clearly a risk-off sort of situation, stating the obvious. But if you look at the MSCI World defensive versus cyclical indices, huge difference. The defensives are still right around peak levels, have hardly budged. Now, maybe they're off today, where the cyclicals have derailed. Think about summer seasonality. 6 of the past 10 Augusts have been negative. 7 Septembers have been negative. It's just that time of the year. I don't want to make too much out of seasonality, but look at the data.
Draw a line for me between what we're seeing, where we are in terms of valuations, factor in this morning's selling, the selling we saw at the back end of last week, and what the earnings picture is telling us. Is the earnings picture grim enough to reflect what we're seeing in terms of market pricing and the moves that we're getting?
So I'll give you a yes and a no, which is unhelpful. But near term, it's not helpful. We've actually seen 2024 and 25 estimates, both in U.S. and Europe, trail off a little bit after having been picking up going into the earnings reporting period. Here in Europe, the growth outlook for the second half is now 4 to 5% earnings growth. It was 7% before the results period started. That said, you look at, here's the flip side, you look at 2025, if we start to see central banks easing, and maybe this does push the Fed a little bit more aggressively, 2025 arguably should be a recovery year. PMIs have drifted. The ISM in the U.S. is below 50. You've got China that seems to be upping the ante on some of their stimulus. So, get past August and September and look for where you see fundamental revaluation being renewed.
Well, you mentioned stimulus of China. I want to bring about stimulus in the States because so much of that money has gone to chip stocks in particular. And you've seen this rally and this option story in the likes of Intel, Micron, you name your chip company, it's gotten a federal grant. Well, you're not necessarily seeing that same story in Europe. Infineon came out with their numbers today. And in that same theme with earnings, you've been covering the chip story from geopolitics to what's going on in the States to, of course, Infineon this morning. Your take on where we should be focusing in that space?
Well, it's a reminder. Infineon's a reminder that across the chip space, there are very different stories playing out. So the likes of AMD and NVIDIA are, of course, focused on those GPUs that are essential for artificial intelligence, and those data centers still doing quite well. The demand was there. AMD upping their guidance in terms of sales to a higher range. And so that pleased investors around AMD. They still got a lot in terms of closing the gap with NVIDIA. They're looking at sales of around $5 billion this year at the top end, $4.5 to $5 billion versus about $100 billion for NVIDIA. So that's that story. The GPUs, carve that out from what's happening in the rest of the space across semiconductors, and Infineon fits into this in terms of the demand for industrial chips and in terms of demand for EVs. Of course, EVs suck in a lot of chips, much more than combustion engine cars. And the softness in terms of the growth coming through, softer growth for EVs, that is proving a challenge as well, and you're starting to see an inventory build-up. So you've got to break down what's happening across the chip space. There are different stories at play. You can make the case, I think, still, that demand around GPUs continues, and you saw, again, CEOs from Microsoft to Meta recommitting, and Amazon recommitting to spending even more on CapEx. Yeah. That should provide some kind of support, you would have thought, for the likes of AMD and NVIDIA. But in an environment where growth is slowing and you're looking potentially at recession in the US, then companies like Infineon may be more challenged.
It's interesting because we're talking about kind of the European companies as perhaps being that catch-up trade in the States, except not quite when you're seeing these recession odds played in. Tom McKenzie, Tim Craighead, we will leave it there. But really interesting going from the macro and the micro, especially in the context of the fact that the Fed is actually expected, I think I mentioned that, 115 basis points right now priced in this market, a 10-year yield at 3.69. And then also you have the ECB now getting priced in to do something similar. Traders now lifting those bets, I say, pricing in 42 basis points of easing in September alone. This is an important story because at the same time, we're also kind of factoring what the Bank of Japan is going to be doing as well. Their hike last week as well, feeding not us into what's going on with the yen, but the ripple effects have a lot to do with those margin calls. Avril Hong talking about that at the start of the show, and a carry trade that has been pretty juicy when you started to see stocks perhaps seen as overvalued, a bond market that just won't quit. And now you're seeing that carry trade really get unwound. So I think this is a really important one to watch, especially as we look at dollar yen at a 142 handle. These are just some of the examples of the carry trade here. And again, you can see that strength into the havens. How much of that is a recessionary story? How much of that is going off of the BOJ? And how much of that is hurting people's portfolios? Guy, there's a lot going on in this market from FX to stocks to bonds.
Are we just seeing a tech stock unwind? Is that
it's an everything unwind, isn't it?
Well, no, is it? So, yes, you are seeing certainly some of the carry trades. You're talking about some of the yen trades.
Yeah.
But if you look at what is happening this morning, the trade out of Asia was very much focused on the tech sector. There was a big move down in the tech sector. Now, that rippled into other spaces. You've got the banks, etc., certainly under pressure as well. Europe doesn't look like it's going to be down that much. The Nasdaq looks like it's going to be down 6%. This feels, is this just simply an unwind of some of the stretch tech valuations that we've seen? Is that it? And therefore, maybe the line that we draw back to the economy is just a dotted one. It's not a real one.
Yeah.
And we're not going to get that kind of, that cycle beginning to emerge.
Well, it's the perfect storm, isn't it, to your point of you had the recession numbers, or I should say the jobs numbers that are indicating recession by some people's views, even though the JOLTS numbers coming in still fairly positive. There's a lot going on in terms of, yes, the economic data, but to your point, the stretch valuations, I think, feeds into the margin call story. So if you're pulling back, if you're seeing that repatriation, for example, in the yen, hypothetically, which, of course, the Japanese are known for, especially in the face of a BOJ that has signaled they're going to be hiking more throughout the rest of the year, does that just mean you don't have money to deploy into other risk assets? Is it as simple as that?
Don't know. It's going to be, I think we're going to work our way through this morning. We're going to get some answers because I think you start to see what people's books look like this morning. You start to understand what portfolios are looking like, how they're structured, where people are going to hide, where they're going to seek some safety in these markets? Is it simply in Treasuries? How does that skew the Fed trade? So I think we're going to start to get greater visibility and understanding of exactly how the market is set up as we work our way through this process. Coming up, we're going to look at some of the single stocks that we need to be watching. Tom was just talking about what is happening with Infineon, under pressure this morning as we see EV chips demand maybe softening a little bit. It's missed its revenue line this morning. We'll talk about that stock. We'll talk about all the other stocks we need to be watching into the open. It doesn't look that great in Europe this morning, but maybe not that bad compared with Asia and the United States. More next. This is Bloomberg.
This is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the US to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now.
Bloomberg opinion columnist Mohamed El-Erian talking about the growth scare post the jobs data we saw Friday. Jobs data, was it skewed by the weather, the hurricane effects? I think there's some numbers which suggest that it probably was, but it's hard to pin down exactly what that is. So we'll wait. We'll maybe get more information as the data progresses. Remember, we get services data a little bit later on the ISM front. In terms of where we are right now, this is what European futures look like. We are going to get a negative open, but it doesn't look anything like what we saw in Asia, which got hit hard. Tech in particular got hit hard, which is interesting in the light of the fact that the Nasdaq is down pretty sharply as well. So is this just a normalization, a recalibration of the tech sector that we are seeing here that was inevitable at some point, or is it something more sinister? Let's try and get an answer to that question. What do we make of the market action? Markets Live executive editor Mark Cudmore joins us now. Mark, what is this?
I think it is just recalibration, but that it can continue for some time, and there'll be knockover effects that will last for some time. I still think the US is likely to avoid a recession, and I think it's bizarre that we've gone, an imminent recession, I should say. It's not going to permanently avoid one. But we've gone from being pretty complacent about the US economy only 3 weeks ago to being convinced of a hard landing. Now, obviously, that hard landing is possible, and recessions do come on very quickly, and the market damage we're having at the moment has a real growth impact as well. So I'm not complacent about it out there, but I think the sudden turn in sentiment is quite extreme. I think there are three narratives to the market sell-off. I think one is the sudden US growth panic. That is perhaps a little bit overdone, but I wouldn't want to fight it just yet. One, there's a kind of deflation of the tech bubble. And that, as we've talked about a lot, Guy, there are extraordinary prices there for some of those stocks. And that can be a more ordinary calibration without it having broader economic impact. And then the third one is the policy misstep by the BOJ, which caused a clean out of some carry trades last week. Those three dynamics are causing pain across all assets, with a particular focus on Asian stocks. I've just not seen a day like we've seen in Japanese stocks ever.
I mean, I want to get more into the carry trade and the FX story we're seeing. But before we do that, I want to talk about this bond market, Mark, because you mentioned that there's this massive pace of deterioration that matters. What happens when it goes in the other direction? When you see a 10-year at 370 and suddenly it corrects or overreacts or whatever it responds to in the opposite direction, do we then see even more pain for stocks? What's the ripple effect of that momentum in the other direction?
Yeah, that's a good question. I don't think that's going to happen too quickly. I don't think that if we do see, these asset moves turn around at some point in the days ahead, I don't think the bond yields map happen first. I think bond yields only bounce after stocks bounce. It's after we get a little bit more comfortable with the growth picture. So I don't think it happens first. I think when we get the next move up in bond yields, it'll happen with a market that's saying, hey, the economy is still okay, if that's the case, and therefore stock prices can cope with it. I do think, though, there's still going to be kind of ripple effects from the VAR impact of funds getting stopped out, traders getting stopped out, and therefore seemingly unconnected positions having to be closed.
Where do I hide in this? What is a safe asset?
The dollar in the short term. In 2008, It was a US-focused financial crisis. The whole US financial system was in jeopardy of going down, and yet the dollar soared. And that was despite the fact that dollar-yen was in free fall back then as well. Dollar works. At the height of financial panic, you do not turn to things like gold or even less so to crypto. They are bets on the monetary policy response that follows. They are the bets that if it gets really bad in financial markets, that central banks will print money again. They are essentially hedges against fiat currency being devalued. But in the moment of financial panic, all these assets get sold off. Gold included, and crypto even more so because it's a higher beta version of gold. So therefore, in the very short term, dollar is the only good haven.
Well, it's interesting that you talk about the haven because, Mark, I want to come back to one of your initial points, which is this unwinding of the carry trade. So hold your that thought. When I really bring a chart that caught my eye here that really illustrates the move and the unwinding of that carry trade that we've seen. This is one of the most popular carry trades out there. It's, of course, the Japanese yen against the Mexican peso. And we've done it here on a 5-6-year chart, basically going back to 2020. It's adjusted on a logarithmic scale to really show the momentum of the move. Now, if you look at the 2020 move, which is the spike kind of midway, maybe 25% of the way through your screen, that is the pandemic. That's the market panic there. But then towards the right, if you really zoom in on that kind of right-hand side where you see that big spark, or big spike, I should say, showing the most recent moves, the carry trade, the momentum behind the carry trade looks almost the same. I also want to bring you updated pricing on what some of those carry trades look like this morning, because you were seeing bids, of course, strength into the Japanese yen, strength into the Swiss franc, strength a little bit in the dollar relative to some of these emerging market currencies. And you can just see that carry trade higher by 6% this morning. Mark, I want to bring you back into the conversation here. How temporary is this move?
I think that the problem with this carry trade blow-up is that it's not concentrated so much in the hedge fund sector. Anecdotally, talking to a lot of my friends across hedge funds last week ahead of the BOJ, many were relatively flat in the yen positioning. Some were even long in anticipation of the BOJ potentially being hawkish. Of course, there are the CTA positions out there, and they've got cleaned out, but they'd already got partially cleaned out ahead of the BOJ. But I think there is a structural short yen position out there, people who've borrowed for long-term structures or exotic structures or structured notes or for real estate investments across banks, across real end users. And it's that yen positioning that I'm worried about because that's what's being threatened at the moment.
All right, Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. Doing a little bit of a wrap-up of the carnage we've seen across various asset classes. You get more up-to-date analysis from him and the rest of the team. Just type in MLIV GO on your Bloomberg terminal. We go from the macro to the micro with your stocks to watch. Joe Easton has it all. Joe.
Morning, Kriti. So one of Europe's largest chip makers, Infineon, reporting some weak numbers today amid a decline in demand for chips used in electric vehicles. Infineon's margins also well below expectations. Free cash flow missing as well, and the company itself citing prolonged weak economic momentum hitting their business. Now, it's worth bearing in mind that this was one of the worst sectors on Friday. We can see a 5% decline in Infineon itself. SD Micro was hit, and we had some eye-watering drops in the likes of ASML and BE Semi, the chip machinery companies as well. In terms of the analyst ratings, Infineon is a well-liked stock on the street, not a single sell rating on that company. 28 buys, doesn't get much better than that, but it would be difficult to predict a rebound in that stock given the broader declines that we are seeing today. Then in terms of the banking space, a bit of M&A. SocGen selling its private banking units in the UK and Switzerland, offloading them to the Swiss lender UBP. This is part of the CEO's progress on slimming down the French company. It's worth around 900 million euros in terms of the price tag, but those businesses have assets under management of around 25 billion euros, so it is pretty chunky in terms of that. This stock also worth noting, a massive drop last week. Now, the company reported weak earnings, but it also was part of that decline in French banking stocks and banking stocks around Europe. I would note that the futures on the Stoxx banking index down 4% at the moment, heading into the cash open, potentially more weakness there. Finally, we've got Aberdeen on our radars. The FT reporting that the temporary CFO is going to replace Stephen Bird as the CEO, with potentially an announcement due tomorrow from the company, according to the newspaper. Now, analysts over at Citi saying that this would be positive, given the CFO is keen to cut costs and is already a credible name among the investor base. But take a look at this drop, down 42% over 5 years. They never really got around to cutting the costs that were promised when they formed the company around 7 years ago via a merger. And also, the board recently rejected a breakup of the company. So a lot of work to do, but again, the broader market moves going to take the focus. Nonetheless, keep an eye on Aberdeen in London.
Joe, great stuff. Thank you very much indeed. Some single stocks you want to be watching out for as we head into the Monday morning opening here in Europe. Cash about to start trading. Kriti, is this more than a tech sell-off? Yeah. That's what I can't get my head around this morning. You certainly saw a lot of tech selling off in Asia pretty aggressively. Tech has been obviously the most bid recently. We've seen a long run for tech. Some of the valuations have been shooting upwards on a week-by-week, month-by-month basis. It's interesting to look at Tradegate pricing this morning. Apple's down. You can understand that with the Buffett story, but you've got Nvidia down pretty sharply as well. So is this just a story of a recalibration of the tech sector, or does it become something more? And if you look at Europe this morning, it's down, but not that much.
Well, that's the stock story. And then there's this bond story as well, which is the momentum to the downside. The fact that we've gone down to a 372 on the 10-year yield is enormous. Getting headlines crossing the Bloomberg terminal right now that traders are pricing in a 60% chance of a 25 basis point cut within just 1 week. So this is massive.
It is, but is there a flight to safety? How accurate is it? Yes, I appreciate that this is pricing, but this is very hard to read pricing.
So flight to safety, the opposite side I'll make it to the argument is this simply a chase for yield? And here's why I say that. If you are seeing a move, it depends on where you see that this is stemming from. If you see that it's started stemming from this trade in FX, it might just be a chase for yield then into the Japanese yen. Right, and a repatriation of cash that has now triggered everything else, which is interesting because that would kind of go in with the dynamic that you've seen play out, where private capital, EM, et cetera, continues to be the story.
The fact that the market is pricing a coin toss as to whether or not we're going to get 25 bips out of the Fed within a week. Anyway, European futures are pointing lower. Cash is about to start trading. We'll bring you the opening trade in just a moment. This is Bloomberg. Monday the 5th, good morning. A couple of minutes to go until we start cash trading here in Europe. I want to talk about the legacy of Friday because we need to factor that into our thinking. Remember, white line here is Europe, blue line is the United States. There's the drop we get post-payrolls, but we finish off the lows in the United States. Subsequent to that, though, the mood seems to have soured overnight out of Asia. We've got US futures down really sharply right now when it comes to the NASDAQ. The S&P's down pretty hard as well. European futures are lower as well. We'll show you those in just a minute in terms of what is happening here. But the NASDAQ is under significant pressure. European futures across the board are pretty soft as well. We're down by 2.5, as you can see on the 50. The future, the FTSE 100 down 1.7. S&P's down 2.68. The story is in tech, it seems, in the stock story. So that's Asia and the United States. Kriti, what are we watching in single stock stories?
Well, it's funny that the single stock stories even matter right now, Guy, but there are a couple here. And I want to start with the earnings picture. Infineon is one that just reported about, we'll call it an hour and a half ago, a revenue miss. And we had this conversation with Tim Craighead earlier, which is that even the earnings story is really not helping this macroeconomic environment. We've also got numbers coming out of, news coming out of SocGen as well. They may be selling their private banking units in kind of that cost restructuring. So that's one. And sticking with the financial sector, Aberdeen as well, appointing, or at least the FT reporting, that they're going to be appointing their interim CEO as a permanent chief. So a lot going on in financial services, a lot going on in the earnings picture as well. But does it really matter, Guy, given that you are seeing risk sentiment broadly? So wouldn't a positive earnings story or a positive development even be well received by this market? Net, you are starting to see futures, like you said, taking a real beating when it comes to the tech space. But S&P futures also fairly low as well.
Yeah, but the earnings story is not a tailwind, it's a headwind, just marginally a headwind for stocks. Right, here we go. It is time for the opening trade here in Europe. We're going to get a picture of what is happening in our part of the world. Remember, Asia, very ugly session. We're pointing to a significant sell-off in tech in the United States as well. Is this just a natural recalibration for these markets as some of the positioning comes in, particularly in tech? There's the opening trade, as you can see. We are soft. We're not that soft yet. Look, we're down by less than 1% on the FTSE 100. We're now down by more than 1% on the FTSE 100. We're expecting, let's call it circa 2% broadly across Europe in terms of the losses that we are likely to see here in Europe this morning. But think about the fact that the Nikkei was down by 12%. it was a really ugly session overnight in Asia. Now, a number of factors are different, obviously, between these two sets of markets. And to a certain extent, there's a currency factor we need to put into the story as well when it comes to Asia. But Europe's down by, let's call it 2%, just shy of 2% this morning. It's ugly, but it's not that ugly yet. So what does that tell us about what we are learning about the nature of this sell-off and what we are seeing sold off and what it tells us about how people's portfolios are positioned? And that tech story in particular, Kriti, how is that unwinding? How is that renormalizing, you could argue, back to maybe something we've seen more historically?
Well, it's no surprise, Guy, that when you look at these opening trades for the FTSE and for the Stoxx 600, it is red across the screen. In fact, brutally so. But there are some pockets of green. I think that's interesting to actually maybe focus in on what's performing well here, because you do have a couple of biotech stocks actually higher this morning and some consumer names as well. I'm curious how much of this shows up as a hedge. For example, let me just walk you through some of them that we're seeing. The Stoxx 600, from an index contribution perspective that are in the green, Unilever is top of the charts. Then you've got GSK as well. So same with Merck, which I think is an interesting kind of trade to make, given that we are indeed talking about consumer concerns at the core of this entire story. You are seeing a couple of banks as well taking a bit of a beating on the downside. We are getting headlines right now that UBS is halted, down about 6%. But there's a lot going on. Commodities seem to be the one that's taking the biggest brunt in terms of index contribution. But then, of course, you are seeing, like I said, some of the consumer names in the green as well, Guy.
It's interesting. So the market is just seeking safety. You've gone back into the obvious safety trades. Unilever and Berkshire and Reckitt Benckiser. You've got L'Oreal in the mix. You've got some of the drinks companies in the mix. Interesting to see Bayer actually in the mix as well. This is totally logical in so many ways that it's slightly alarming. But understandably, maybe some of the banks are coming under a little bit of pressure. Some of the stocks that have been bid so strongly recently. The FT running a story, I think, over the weekend asking when the Rolls-Royce rally was going to run out of steam. Well, this morning, that stock is down by, let's call it 6-7%. The stocks that have been really strongly bid recently are understandably the ones that are going to get hit hardest.
Exactly. And I'm curious how long this actually lasts from a pain point of view. When we do kind of see that continued sell-off, is this a one-day thing? Do we see a buyback? When we compare this, and I think a lot of folks are comparing some of the carnage that we've seen to previous crashes in 2022 and 2020, it tends to be the volatility that we keep an eye on. So a big sell-off one day, a big sell-off on the other. And I think the red on the screen you're seeing here is just really, again, the breadth of the sell-off that we are seeing in today's trade. So it's not, again, that surprising from what we've heard.
So the next question becomes, is this orderly and rational? And if so, does it stop in a logical place? I.e., does it not feed back into the real economy? Because if it feeds back into the real economy, this sell-off, then you start to see, as you were pointing out earlier, a financial conditions effect, and that starts maybe to exacerbate concerns on the downside that we get a recession, and it pushes the US into recession. And that's the fear here. Or is this just an orderly reorganization of the markets? Tech's got to extremes, starts to come back in again. Some of the banks begin to retrace a little bit as well. Some of the moves that we've seen recently just kind of renormalize. Well,
the latter feels like the easy response, right? In that this is simply just markets being markets. This is traders trading. It's as simple as that. But I want to bring it back to the other argument, which is that maybe fundamentals are actually driving this. You mentioned those recession odds. We look at the 2s-10s curve. It's now inverted again 5 basis points, but it's completely changed. The other, I think, phrase a lot of people have been talking about in the last 3 days or so has been the Somm rule and whether or not it's been triggered. Well, we heard from Claudia Somm herself on whether it's been triggered and what it actually means for this economy. Take a listen.
That puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. 4.3%. Right? This is not. So whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Again, I don't overread one data point, but this isn't one data point.
Claudia Somm there, chief economist of New Century Advisors, and of course the creator of the Somm rule. Let's get a little bit more context here. Joining us now, Christian Mueller-Glissman, head of asset allocation research over at Goldman Sachs, joining us around the table. A pleasure to have you on the program. Man, did you pick a good day to join us? Look, at the core of this concern, whether you call it market positioning or whatever, is the payrolls report we saw on Friday. Is these concerns about a recession, as Guy and I were just mentioning, are they valid?
Yeah, listen, I think it's been a long time that we had a correction, and I think that's important to keep in mind. And we turned tactically a bit more cautious 3-4 weeks ago, roughly, and there were 3 reasons. I think the first reason was the U.S. economy and generally U.S. data has been weaker, and it's been weaker for 2 months now. This is not the first print we got. Yeah. And the market has treated that as bad news as good news. If anything, we actually saw the S&P futures positioning move more bullish in the last 2 months. So you had this disconnect. Bad news was good news, and the market was actually getting more bullish. That was the first concern we had. Eventually, the Fed buffer cannot be big enough, or the bad news becomes bad news. The second reason was valuation expansion in the tech space. I think last year, the Magnificent Seven, a lot of the performance was actually driven by earnings revisions. This year, a lot by valuations. So our team, David Kostin and so, they were really highlighting this earnings season, high bar to beat. And the third reason was the U.S. election uncertainty picking up. So all of these factors have actually materialized, and they've contributed. But of course, as you were saying, the most important has been the U.S. data weakness. I think the U.S. data weakness has also surprised us a bit. Our economists are not that worried, and we can discuss that. But all in all, I think we're dealing with a correction that, it's a terrible word to use, but it's somewhat healthy. You've had a very strong run this year. Positioning was a bit too bullish. The data picture has been a bit more mixed. We have more election uncertainty coming up. And I think to some extent, it's a healthy correction.
A healthy correction in stocks, perhaps. Is a 70 basis point move in the 10-year, or the 2-year, I should say, either one, pick your metric, they're both down about that. Is that a healthy correction?
I think a bit to what Guy said earlier, I think it's a healthy or rational move, in the sense that the market needs to price now downside convexity into rates. I think before there was a lot of focus on normalization cuts. Normalization cuts are steady, whereas if you have reactive Fed cuts, we know that the Fed has a lot of buffer to potentially cut. You need to put in the probability of very large cuts now. So to some extent, again, it's somewhat rational. But that move, I think, is tough to extrapolate from here with our base case macro outlook, because it really starts to move towards a higher probability of a recession. And to be clear, our economists have increased their probability of a recession. I think they were at 15% just before the weekend, which is the unconditional probability. Now they're at 25%. 25% is still not a shocker. Yeah. I think considering your very late cycle in some regards, that needs to be reflected by the bond market. So it's somewhat rational.
How far away are we from the point where assets start to rotate lower and that feeds back into the economy? At the moment, this is a healthy correction, to use your words, i.e. we get back to a more equilibrium state. How easy is it to put your finger on the point at which we say, actually now this is going to start to affect consumption, this is going to start to affect sentiment, this is going to start to push the ball, the snowball downhill even faster, and it starts to gather a little bit of pace?
I think...
How difficult is it to judge that?
Very tough to judge. I think our economists have obviously their financial conditions model, and you've come from a relatively easy financial conditions level, so there's a bit of a cushion before you really get into terrible contraction territory. But I would say, I think one of the core things that has been interesting about this expansion is you have a very healthy private sector. So there's very few financial imbalances. Normally, the reason why you worry about financial conditions tightening is because it flushes out financial imbalances. Yep. You create deleveraging pressure. And you see this in the markets right now. The yen carry trade is a famous imbalance which is currently unwinding. But the question is, do you have financial imbalances in the U.S. economy that are really unwinding in a violent fashion? And what we've been saying is that the private sector in the U.S. is unusually healthy, considering how late cycle you are in some regards. So there hasn't been a lot of re-leveraging in the corporate sector. There hasn't been as much re-leveraging in the consumer sector. What has been the case, though, is that U.S. households have an enormous allocation to equities, the largest household allocation to equities on record, near the tech bubble levels. So the wealth-to-income ratio has massively expanded. That helps the consumer feel very good about their consumption.
But does that reverse now?
And that is at risk of reversing.
Okay. So if you have wanted to not underperform, you've had to be long tech. So we're now in a position where tech starts to come down. do I just have to accept, therefore, that I'm going to underperform the market at this point, that the S&P is going to underperform the equal weight? What do I do in a portfolio now? I've been chasing returns, I've been chasing performance because I've had to have been in tech. How do I reposition my portfolio? Is it just I go back to a 60-40, I go back to a more diversified portfolio? What do I need to be doing right now and thinking about? I'm not talking about a knee-jerk reaction here, but kind of if the period of tech underperformance is coming to an end, how different does my portfolio look in this new period?
I mean, the first question is, does it really come to an end, or is it a temporary episode?
Yep.
But I think what we've been saying this year, and you might remember this, we've been very bearish on 60-40 for the last few years, 2022, 2023. But this year we said you should go back to 60-40. And we said you should start to think about building a robust 60-40 portfolio. The bond market can help you again. And as we just discussed, the bond market did help you. So I think if you are in a 60-40 portfolio, you're not in a terrible spot in terms of performance right now. Certainly, you've caught up a lot of the underperformance. Am I going to
catch up? Yeah.
Yeah, you've caught up a lot of the underperformance versus an all-equity portfolio. Because there were a lot of people just 3-4 months ago saying, why would you bother with bonds in the first place? So I think 60-40 is not a bad idea. It depends a lot of what you do within the 60 and within the 40. So within the 60, to your question now, should you completely rotate away from tech? I think there's already a large correction, and you need to kind of probably be a bit more discriminate. Some of those business models are still very attractive. I'm not a stock picker, so specific stocks like Nvidia, they might be more under scrutiny because of the AI capex. But a lot of the tech stocks we know have very solid business models, are cash generative, strong balance sheets, and are actually not as expensive as during the tech bubble. So I think for long-term investors, these stocks might still be very valid. What we've been saying is you want to have a barbell strategy of large-cap quality growth stocks, which might include tech, but there's plenty of other compounders in the world. And you pair that with deep value opportunities that have the ability to re-rate and don't have as much valuation downside. And I think that strategy still stands. But now to your question, what do? You need to rotate a bit more defensive. I think for sure you need to think about defensives in the portfolio. We've been very bullish on healthcare as an example. And one of the styles which has been one of the worst performers in recent years is low volatility. I think you want to think about the low volatility style across the equity complex. It's been a big underperformer, but now with lower rates, because it suffered a bit from leverage, and to some extent focus on growth, low volatility can be a very interesting addition.
So in 2008, not that we're there, but in 2008, the Norwegian Sovereign Wealth Fund bought the bottom of all of these tech stocks. It ended up being one of the most profitable trades, I would argue, in the last decade for a player of that size. Is this just one big green light to buy tech right now? Now that you have this valuation overhang that's kind of disappeared, if you do actually see the carnage carry on to the U.S. session that we're seeing right now, is that what I'm hearing from you? Buy defensives, find the liquidity, find the safe havens. Doesn't tech just check that box?
I don't know. Like, the problem with tech is it's actually a volatile sector. It has high valuations. It has long duration. You pay for future cash flows very far out in the future. Yeah. So it's very sensitive to the cost of equity, to equity risk premia. Some of those business models also have disruption threats. There's a lot baked into these valuations. So I think they're definitely not as safe haven as like healthcare. But I think you're right, depending on how long your time horizon is and how good your stock picking is, picking the right tech business models that actually will in 10 years still have significant market share and business opportunities. I think there is probably an opportunity. I would just give one statistic. The average or the median drawdown of the NASDAQ in a calendar year since 1990 is actually 16%. So we're at 11. So far. So we have to be a bit careful because buying the dip is always something you should do in very fast drawdowns, in very large drawdowns. But I wouldn't say that we have seen the median drawdown even. And from that perspective, you need to also be careful to go in too early. But the longer your investment horizon, and the Norwegian government has a very long-term investment horizon, the more you want to take advantage of these drawdowns, definitely.
Christian, great to see you this morning. Perfect morning to see you. Thanks for stopping by. Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Thanks very much indeed. European equities are down, let's call it circa 3% right now. Technology is the lead loser. Banks, energy, also in the mix as well on the downside. Quick look at where we sit with some of the core stocks that we always monitor here in Europe. This is what the picture looks like here. And as you can see, there is some safety being sought, but you're not even finding an area of safety in a stock like Nestle this morning, which is still down by 1.5%. But look elsewhere. Novo down 5%. LVMH 2%, Ferrari 2%. So luxury's doing okay. Tech is definitely where the weakness is. Schneider's in the mix as well. So actually luxury may be a place to hide this morning on a relative trade versus maybe that tech story out of Europe as well. Let's find out what else we're watching this morning. Joe's got plenty of movers. Over to you.
So as expected, Guy, a lot of these single stocks moves just being wiped out by this broader market decline today. And in fact, just 10 stocks on the entire Stoxx 600 were in the green as I looked at the open of trading this morning. But just on these chips, we're seeing Infineon coming down around 3%. Now, actually, some analysts saying the sales decline wasn't as bad as expected, but still the stock coming lower. There are also separate reports around a potential delay to one of Nvidia's chips overnight as well. But really, the broader market move decline, as you were discussing in the tech sector, weighing on the other chip makers, BE Semi. ASML down now almost 20% over a 3-day period, a massive decline in that stock today. There were a couple of corporate earnings to take a look at as well. There's a few declines. I was seeing a pre-market decline on United Internet. This is the German classified website company, a bit of a sales miss. Company, and also PostNL over in the Dutch postal space. A bit of a positive one on that one finally, but as such, we are seeing declines in most of those earnings companies today. There is some deals news flow to look at as well. Quite a lot going on in that space. We mentioned in Stocks to Watch, SocGen offloading this wealth management unit, potentially 25 billion in assets under management. L'Oreal buying a stake in Galderma. This is a skincare company over in Switzerland, potentially worth around $2 billion, a sizable deal for that one, coming up 2.5%. OCI selling one of their fertilizer businesses based down in Texas. That's a decent deal as well. And John Wood Group going the other way, down 39% as private equity walks away from a takeover of the UK oil engineer. Interestingly, they note recent financial market uncertainty, one of the reasons they are walking away from that one. Aberdeen, meanwhile, not quite getting the boost we thought it might from the FT report on a potential new CEO coming in. The CFO, the temporary CFO, may be taking over that position according to the FT, but the broader market moves wiping out any positive on that one. In terms of morning calls, a couple in the UK today. Lloyds gets a downgrade, this one over at Citi. They're citing the weak net interest margins at the company just around a week ago in their latest earnings report. And finally, we've got a move on United Utilities underweight over at Barclays. That's interesting to me because the decline in bond yields should be positive for that space. But a lot of utilities in the UK had a recent boost following the election, and Barclays is downgrading a number of firms today. Underweight on that one, and we're down 4% on United Utilities.
All right, Joe Easton there from our equities team giving us a little bit of a roundup of some of the stocks that are moving in the early trade. Coming up, we're going to dive into one of the sectors he was talking about, Infineon joining a global tech sell-off. This comes, of course, the German chip maker's revenue misses estimates. We're going to break down the details next. Stick with us. This is Bloomberg.
Morning, Monday the 5th. We're 22 minutes into the equity session here in Europe. This is what it looks like. We're down, let's call it circa 2% in Europe. Tech is down pretty hard. Now, you think about what is happening here. A lot of people, if you've wanted to outperform, you've had to have been long tech. So a lot of people have been long tech. They wanted their portfolios to outperform. They've probably been overweight equities as well, quite significantly. So they don't necessarily have the ballast in their portfolios to protect them from a big downside move in tech. So I think you need to factor that all into your thinking this morning. But Europe is not down that hard relative to the rest of the world. But chip stocks are certainly where we are seeing some weakness, Kriti, this morning. And that's totally understandable. This is where those stretched valuations maybe have been most acute.
Well, I'm waiting for whether European chip stocks are on the same page as American chip stocks, because in the lead up to the sell-off and then going into last week, and I would argue last couple of weeks, you've seen that a lot of the options volatility has actually showed up in Intel, in Micron, et cetera. And I was waiting for kind of the read-through into Europe. And I didn't get one last week, but I might have gotten one this morning. Joining us now, Bloomberg Daybreak Europe anchor Tom McKenzie, all over the story. Is Infineon the poster child this morning, or is it kind of doing its own thing?
Infineon is a reminder that those chip companies, those semiconductor companies that are really have that exposure to kind of the cyclical movements of this global economy and the industrial space are much more sensitive in this environment. Look, this is a broad-based rout, of course, across the semiconductors, but Infineon's sales dropping more than expected, the margins coming in lower than expected. They have particular exposure, and this has been a concern for a long time for Nvidia, their overexposure to the automakers, the OEMs in Asia as well, in South Korea and Japan. And as those companies pull back on their build-out and their supply of electric vehicles, then Infineon was going to be impacted. And that's what's come through so far. So that is the question for Infineon going forward. On the AI story, they just have 1%. They have a bit of exposure to AI, but only 1% of their revenues come from AI-related chips. This is all about the industrial play. It's all about EVs. It's about so
this tells me nothing about
and
Nvidia.
Rising inventories.
So this tells me nothing about Nvidia.
I think you can put it to one side. I mean, Nvidia, again, we saw this from the earnings story again last week in terms of the CEO's executives coming out and not walking back their investment plan. Does that change? I don't know. We've got them on record committing to that capex, not just this year, but through to 2025 as well. We heard that from the CEO and the CFO of Amazon, reiterating that, from Meta, from Microsoft. And who wins in that environment? It's Nvidia. And AMD is coming through with a bit of catch-up. They still have a long way to go. So I do think you can put them into different buckets and different baskets, because Infineon is not just sensitive to the slowing demand for EVs, but also to the cyclical elements. If we get into a recession territory, the inventory build-up's already there, and they look a little vulnerable at this point.
Talk to us about the inventory build-ups, though. I mean, one of the big questions, maybe not now, but in 6 months' time, is how much of this sector is subject to subsidies on both sides of the Atlantic, even in Europe, where Infineon and other EV makers may be getting more of those green subsidies. Does that matter right now?
The subsidy element is one that possibly could be an impact. Look, we're seeing, of course, that massive fund push that's coming through in terms of the US to build out the foundries. Intel has been a beneficiary of that, and yet, of course, it had that record drop last week because of the cost still, even with those subsidies, of kind of building out that foundation or foundry play for them, which is a massive gamble, of course, by Pat Gelsinger and co. In terms of what's happening in other parts of this chip market, Samsung was a reminder as well, in terms of their earnings, that in terms of premium, so premium smartphones, that segment's holding up quite well, but it's the more commoditized part of the smartphone market where there's still that softness. So again, you have to break these into different categories. The premium end, so the iPhone 16, possibly that is going to lead to some upsides from Samsung in terms of the supply of chips to those smartphone makers. But in terms of the mid-range and mid-end smartphones, there's still some softness there, and there's still an inventory challenge.
A fascinating dynamic that you're seeing in the chip space. We're going to leave it there. Bloomberg Daybreak Europe anchor Tom McKenzie walking us through when the earnings meets the geopolitics meets a broader market sell-off. I don't even know what is driving the trade. And then you have to factor in things like geopolitics as a part of all of this.
Yeah, we're going to talk about what is happening in Israel in just a moment. I just want to come back. The bond market story, we haven't talked about it a great deal this morning. The market's pricing in aggressive Fed rate cuts within a week, which feels very extreme to me. Like 114 print, is that going to take us in that direction? Maybe geopolitics is another factor we haven't kind of spent enough time talking about this morning. We're waiting for a response out of Hezbollah. We're waiting for a response potentially out of Iran. We're looking potentially for a imminent strike. That's what Axios is reporting. So we're going to find out what that could potentially mean in terms of the market reaction that we're getting this morning. Axios is reporting it could come within hours. We'll talk about it more in a moment. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. You are seeing red across the screen on really all around the world. You saw it in Asian stocks. You're seeing the read-through into European stocks. Your underperformance right here. But it's really that tech pain that you're seeing. NASDAQ futures kind of paring back some of those losses, but still down 4.5% in the States. And, of course, chips really taking the brunt of the hit this morning when it comes to those European stocks as well. Another sector I don't think we've given enough focus on is going to be the commodity sector, because that's also where, especially when it comes to the FTSE, you are seeing a lot of the pain when it comes to the sell-off. And a lot of that's just magnifying the move you're seeing in commodities. commodities as well. Oil right now trading at a 76 handle for Brent crude. You're seeing NYMEX at about 73 handle. That spread between the two narrowing down to, we'll just call it $3 and change, if you will. And that is all as pricing not only just the risk sentiment, but the geopolitics coming out of the Middle East as well, where Israel is bracing for a possible attack in retaliation for the assassinations of Hezbollah and Hamas officials, while the U.S. continues to press for a ceasefire deal. Now, yesterday, G7 foreign ministers expressed concern about the risk of a wider regional crisis during a video call. A lot of developments, a fast-moving story. Let's get more perspective. Bloomberg Jumana Berkshire joins us now from Dubai this morning. Jumana, walk us through what we learned this weekend.
Yes, well, what we learned is that an attack certainly does appear to be imminent. The U.S. Secretary of State Anthony Blinken held a call with his counterparts from the G7, Axios reporting that he told them to expect an attack on Israel from Iran and its proxies, be they Hezbollah and Houthis, in a matter of 24 to 48 hours. This at the same time as he called for an urgent de-escalation of tensions in the region. But we also know that the U.S. Central Command chief, that is the General Michael Kurilla, arrived to the Middle East region on Saturday. He is expected to try to shore up regional and international support, a coalition, so to speak, to support Israel's air defense system, similar to what happened back on April the 13th. You may recall that Iran direct attack onto Israel, unprecedented in nature. More than 200 missiles were sent towards Israel, but they were intercepted by this coalition. And so the U.S. Central Command chief is there to try to shore up support for a similar coalition to be put in place. This, as we know, is the U.S. is also sending further military ships, fighter jets to the region. Some airlines have suspended travel into and out of Tel Aviv, the likes of Air France, KLM, and British Airways suspending travel. Embassies in Lebanon advising their citizens to leave the country as soon as possible, including U.S., France, UK, Australia, and more recently Saudi Arabia and Turkey as well. And so the entire region is bracing for something to happen in the next 24 to 48 hours.
Is this a regional conflict? Is this the wider war we have feared? Talk us through that. Is this a catalyst to maybe get a ceasefire in Gaza? Talk us through the implications, if this attack comes, of what it's going to mean.
Well, Guy, we've been speaking to many analysts from the region, experts who have been in the region for decades, and many people say that this is the most heated moment the Middle East has seen in years, and namely because we're not just talking about one specific touch point or hot point. We're talking about various fronts being opened up. And you speak of the likes of the Ayatollah, the supreme leader, Khamenei, saying that they want to retaliate on after the assassination of that senior Hamas leader within Tehran, embarrassing for their own security. You talk about Hezbollah chief commander Hassan Nasrallah last week delivering a speech where he vowed vengeance, saying that this war has moved on to multiple fronts. We continually monitor those Houthi attacks on vessels going through the Red Sea. And so there are many fronts opening up here, and it certainly does appear to be the case that all of those proxies are preparing some form of retaliation. The risk of a misstep is very high. At the same time, we know that the U.S. are continually pushing for a progress on those ceasefire discussions. So if there is going to be a release valve, it will probably be in the form of getting a truce over the line. But at this point, there are still a lot of stumbling blocks. And even though the fact that Israeli delegation went to Egypt over the weekend to make some breakthrough on those talks, there was no progress. They came back early. The two sides seem to be far apart. Israel are saying that they don't want to move on from phase 1 to phase 2, i.e. from a truce to a permanent ceasefire, until they have completely neutralized Hamas. And they're also insisting on control of a corridor around the Philadelphia corridor on that Egypt-Gaza border crossing. Hamas are saying, or whoever is left from Hamas negotiating team are saying, that they will not accept the terms of a ceasefire until they have reassurance that it will lead to a permanent end to the war. So again, a lot of daylight, but the U.S. seem to want to keep pushing for that ceasefire as the only way of bringing down the tension in the region right now.
Jumana, thank you very much indeed. Jumana Berkshire joining us out of Dubai on what is happening. We're going to keep a careful eye on the news flow over the next few hours as we anticipate this retaliation. We'll bring you the news if and when it comes. Let's talk about the implications of the story for commodities. Oil is the obvious kind of route through this story, but actually this morning in some ways not a big reaction, as Kriti's been talking about already this morning. We're down by 0.2%, not a big move to the downside. Joining us now, Angelina Valavina, head of the Natural Resources and Commodities team, EMEA Corporates at Fitch Ratings. Angelina, thank you very much indeed for your time. Look, we are seeing a sell-off in a number of assets this morning. It's interesting that energy stocks are under pressure as well in the mix. Why are energy stocks not a good place to hide in this kind of environment? Is this the kind of environment where we could see further downside because of the recession fears that increasingly appear to be growing?
Good morning, and thank you for having me on the program. Yes, you're absolutely right. So on the one hand, there is a geopolitical risk premium, which is an important component in the commodities prices, especially in the oil and gas prices. On the other hand, there are concerns about the moderating global economic growth, moderating Chinese demand growth for oil, which serves as a lead or as a cap on the oil prices. So if we look at the geopolitics, this risk does increase the prices, but the impact remains temporary, adding to volatility in the prices. So far, there have been no major interruptions to oil production or oil flow despite the tensions in the Middle East, and this underpins the supply side. Having said that, large spare capacity at OPEC+, rising supply, and as mentioned before, moderating demand growth keep pushing the prices below the $80 per barrel for Brent, as you've shown before on the screen. So on the demand side, we expect demand growth to moderate to below 1 million barrels per day for this year, compared to our previous forecast, marginally above 1 million barrels per day. The key contributors to this revision are weaker Chinese growth, demand growth for oil, concerns about the pace of the global economic growth, and efficiency gains. On the supply side, supply is continuing to grow, and as I mentioned, there is a huge OPEC plus spare capacity.
Okay, that doesn't sound great if I'm an oil major. So what do I do? What do you see in stocks like BP and Shell, both of which are down this morning? BP's down by 2.5%, Shell is down by 3.5%. Draw a line between the stories you've just been describing and what happens with some of these stock stories here in Europe, which so many people rely on for income. How stable are they?
So I run the natural resources team at Fitch Ratings. So we're a credit rating agency, and as such, we're looking at the credit profiles of the companies. But given that there is a cap on the growth in the oil prices, but at the same time, the geopolitical risk, the modest growth and demand provide support and the floor to the oil prices, they still remain quite healthy. So we forecast the oil price for Brent at $80 per barrel. Therefore, the results, let's say, for the oil majors like Shell or BP were quite good in the first half of this year. And they were in line with our expectations. They were largely in line with the market expectations. And that obviously is reflected in the market dynamics and potentially in the stock prices for these companies.
Angelina, that all makes sense. And let's do it through the lens of the credit space, as you suggest. If we see some of these big oil majors being these kind of high yield, chunkier, yield driving kind of assets that people add into their portfolios, how much of the U.S. shale supply matters to this story? How much of it cushions that geopolitical risk that you were just outlining?
To some extent, because if we look at the global supply growth, this year it's relatively modest. It's lower than 1 million barrels per day. But next year, we expect the supply growth to be well above 1 million barrels per day, around 2 million barrels per day. And most of the supply growth will come from the U.S., partially from Canada and Brazil as well. So U.S. production growth is an important component of the supply growth. Having said that, the spare production capacity at OPEC+, which is well above 5 million barrels per day, is a much more significant cushion for the supply if there is any physical supply disruption due to the tensions in the Middle East. This is much more significant cushion, and this is what provides a constraint on the magnitude and longevity in the oil price increases.
Angelina, just as we speak to you, we are getting headlines out of Iran. The foreign ministry spokesperson, Nasser Kanani, speaking in Tehran. And I just want to bring you these headlines here. He says no one has the right to tell Iran not to punish violations. Also saying we have the right to punish Israel in the framework of international law. Again, these are some of the comments we largely expected from the foreign ministry itself. But Angelina, for our global audience here, break down where that pressure comes from. Because when we talk about Iranian supply in this market and the read-through from geopolitical risk, a lot of the analysis has come from American sanctions on Iranian oil rather than Iranian output itself. Is that still the narrative here?
So the Iranian oil production and supply to the global market is probably of less of an importance in terms of the overall global supply. The key risk here is geopolitics and potential disruptions to the physical production of oil in the Middle East or to the supply of the oil in the Middle East. So, for example, if the conflict affects the Strait of Hormuz, where a large chunk of the oil supplies or oil flows is going, then there may be repercussions for the market and there may be repercussions for the oil prices.
Okay, that would be a very extreme situation.
Correct.
How big a tail risk is that right now?
So it's about 20% of the global seaborne oil flows are going through the Strait of Hormuz. So if there are significant disruptions and they're relatively lengthy, then obviously the impact will be quite substantial. But as I mentioned, again, we have 5.8 or 5.7 million barrels per day of the spare capacity at OPEC Plus, and then there may be some redirection of the global oil supply. But having said that, there will be an impact on the oil prices, and there will be a high geopolitical risk premium for that.
How much volatility do you think we're going to expect in the oil space? You've laid out, you've got competing scenarios. You've got the economic slowdown in the States, the global economic slowdown, plus the geopolitics on the other hand. Are we just going to basically oscillate between one fear and the other fear? And both of those fears are going to drag prices in different directions. So are we setting ourselves up for big swings in energy prices?
So far, the swings were quite muted, around $5 per barrel. So the price is hovering between 80 to 85. If there is a significant escalation, then these swings might be much bigger. It can be $10 per barrel. It can be $15 per barrel. But I don't think that they will be protracted in terms of the time frame. Because again, there is spare capacity in the market, and the supply side is managed by OPEC because quite a few million barrels of oil per day were removed from the market by OPEC. And if these barrels are coming to the market, then this will balance the market. But the swings might be quite bigger than their current.
But Angelina, is that a dislocation? Is that something that the oil market, oil traders are getting wrong? And I bring you the stat here. Last week when we had these developments from Israel, the attacks in Lebanon, not to mention in Iran as well, oil only rallied about 2%. And if you put that in a standard deviation alongside all of the geopolitical kind of spikes we've seen, traditionally that spike looks like 4 or 5% in the oil price. You said it perfectly there, which is that this isn't as big of a reaction as we would traditionally get. Why not? Is that a mistake from the market?
I don't think it's a mistake. I think it's a supply and demand balance because the market started realizing that the supply side is managed. There is overcapacity, but then the demand side, albeit demand is growing, it is growing at a moderating pace. So even before we expected the growth of over 1 million barrels per day, as I mentioned before, now we expected it below 1 million barrels per day, which is quite a muted growth. It's below the average for the last, let's say, 10 years, which was marginally above 1 million barrels per day. It's mainly because there is a slowdown in the Chinese consumption growth for oil, and there are concerns about the global economy. But in addition to that, we shouldn't forget about efficiency gains, and we shouldn't forget about the energy transition, which effectively means that in the longer term, the demand for oil will structurally change, and it will be slower.
Certainly a lot to digest. Angelina Valavina, head of the Natural Resources and Commodities team in EMEA Corporates over at Fitch Ratings. We thank you so much. We're continuing to get headlines coming out of Iran as well. Of course, it's coming from the Foreign Ministry spokesperson. Iran is saying they're not looking to escalate tensions in the region, whereas previously they had, of course, said they have the right to defend according to international law. We'll bring you all the headlines as we get them. But coming up on the program, European stocks continue to drop along with NASDAQ 100 futures, kind of pairing some of those losses, but still down over 4%. We're going to dive more into this market route next. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session. You are seeing red across the screen from the equity markets. Arguably some weakness that you were seeing in the European, well, like it looks like the European currency had moved back, but weakness in the dollar, as I think we'll call it. This all seems to have come, at least in part, from some of the sell-off you saw over in Asia. And a big chunk of that is what we saw in the yen as well. We're looking at dollar yen at a 143 handle. It did drop as low as 142 as well, pairing some of that initial move, but still pretty significant from the 150 that we were at last week. At the same time, we are just now getting headlines from the Japanese finance minister as well, Nichi Suzuki, speaking as well, commenting, or lack thereof, about whether the current FX levels are indeed sudden. She says they can't comment on whether they reflect the fundamentals, but they are indeed going to be watching those moves. Let's get a little bit more insight here on where we go in the FX space. Markets Live executive editor Mark Cudmore joins the program this morning. Mark, we talked a lot about the sell-off, a lot about the fact that tech may be in the States driving this. What happens next for dollar yen?
I think dollar yen still has some more downside. I think we're in a little bit of a trader's market at the moment. So there's a bit of momentum. There's still a bit of positioning clean out to happen. I am in the camp that at some point when this moves stabilize, I think yen will start weakening again. The fact is, it still has deeply negative real yields that must remain deeply negative because Japan cannot afford positive real yields because the economy is too stagnant and can't sustain its debt pile without those deeply negative real yields. And that means that when things calm down, when we've finished cleaning out these positions, whenever that happens, the yen will still be the obvious, funder out there. It'll still be the trade to shorten. So I think that at some point it is time for the yen to depreciate again. Is that going to happen imminently? No, probably not, because I think the rout we've seen today will have spillover for the days and even weeks ahead, and therefore we have more pain to come.
Mark, is what we're seeing Friday, this morning, out of Asia into Europe, potentially into the United States, is this a rational move? As you say, clearing out of positions, there's been some leverage, tech is taking the biggest hit. Does it just end there? Does it stabilise? Is this something that kind of naturally works its way out? The story fizzles out eventually? Or is this something that has the potential to start driving further moves, i.e., we get it to the point where it starts to affect the economy, where we start to see maybe the Fed having to take action, emergency action, to deal with the downside that we're seeing in risk assets? How finely balanced is this at the moment? Where are we now? Where could we go?
Yeah, it definitely has the potential, and it is very finely balanced. I think it's a great question, guys. Like, where are we? I would say that, if we recover quickly, I think the economy will be fine, and I think we'll move on from this. But at the moment, there are a lot of panicked people out there. And if these moves sustain, you have a material wealth impact. At the moment, that negative wealth impact is mainly paper wealth, and it doesn't really see that real economic impact unless it sustains. So I do think it's finely balanced. But, I always worry about the saying irrational, because the market is always right. But it does seem like these sudden repricings don't tally with the economic inputs, the fundamentals we've seen going in. It seems weird that we've got such a significantly different view of the world than we had this day a month ago. And that seems awry. Yes, things may have been expensive and exuberant before, but now we've gone to sheer panic, and that seems wrong. Now, obviously, your instinct when I say things like that is like, well, surely it's time to buy the dip. Everyone knows the mantra, the investment mantra, buy when others are panicking. However, if you look at the history of Japanese stock markets, they've basically had 5 precedents in history where they've sold off this powerfully, this quickly over a few days. And that is the March 2020 COVID panic. It is February 2016 when we were worried about China and global growth. It is 2011 tsunami. It is October 2008 post-Lehman. And it is October 1987 in Black Friday. And only one of those times did the Japanese stock market not go on to make further lows in the months ahead. And that was the March 2020 panic, where COVID panic, where we basically had unprecedented combination of fiscal and monetary policy response. And I just don't see that happening a week after the BOJ just hiked rates. So I think there's unfortunately more downside to come. And therefore, I am worried about the potential for this to become a real economic impact, even though it's not my base case at the moment.
To that point, Kriti, I can't yet get my arms around whether or not Friday was an anomaly. Was the data that came out of the United States an anomaly? Was it weather-related? Did the hurricane have a big effect? Was that data not telling us the true story of what is happening in the United States? Claudia Sam was talking to Bloomberg Friday. She was saying it's not just that piece of data. There are other pieces of data. But it feels like that piece of data, the non-farm payroll number, has been a catalyst. And if the signal from it is erroneous... then maybe the market reaction is wrong as well.
There is a sensitivity to downside data that is almost asymmetrical right now. And I think this comes back to 2 months ago when we had poor CPI prints, poor PPI prints, and it seemed like that whole set of data pointed to some sort of slowdown, and then it kind of revamped in some of the inflation data as well. But the market took off.
The market didn't slow down during that period.
No, it saw it as a sign of confidence that things were happening. But that was the point where you say that was one data point. And now you're saying, okay, well, these are a couple, to Claudia Saum's point. But from an investment point of view, Mark, I want to bring you back into the conversation here. When it comes to kind of hedging some of this concern, whether it's recession or whether it's fear of a sell-off or a flash crash, whatever we end up calling this in retrospect, where do Japanese assets fit into that equation at a time, or I want to say just like a month ago, when JGBs, the yen, Japanese banks served as a hedge in a lot of people's portfolios? Is that still the case after this carnage?
No, I think it's slightly different. It's a great question because obviously at times this portfolio management is what decides the winners from the losers, right? Because the temporary long-term fundamentals go out the window. And obviously when you're getting into this panic, as we discussed earlier, people are going to be out there looking to buy panicked and oversold assets. But I don't think Japanese stocks are where those attempts to buy the dip will prove most fruitful. So I think other stock markets will gain. I don't think Japanese stocks are going to come back in vogue that quickly. I think JGBs are still problematic, but I don't think they're going to suddenly be a panicked asset. And as I said, even though I think the yen can be a depreciation story again, it's not yet. It's too soon to get excited about trading those long-term negative fundamentals in the yen. The fact is, even though we might have cleaned out a lot of the weak hands, the short-term players, there's a massive overhang of structural yen shorts out there via funding of long-term structural notes. Many of those notes are going to be owned by like private high net worth individuals that won't even know about their losses for another month or two. So the consequences of this will take a real long time to feed out. Yep. And I think it's only a couple of months from now that you start kind of getting excited about the long-term yen depreciation trade again.
Yeah, maybe they'll have worked their way through the volatility and private markets will do what they're supposed to do, which is not mark to market instantaneously, and you don't have to deal with the volatility. Mark, great stuff. Thank you as ever. Some great coverage coming up. MLIV Go is the function you are definitely going to want to plug into your Bloomberg terminal this morning. I don't know. This morning is fascinating. To Mark's point, it's about you're seeing some position clear out. You are certainly seeing that. That's really clear. Japan is an obvious place to look. In a few minutes' time, 4 minutes' time, we're going to start to get early pricing on some of the US tech stocks. Yeah. What are they going to tell us about how the session is likely to progress? And how does that ripple effect to the other assets, right? Because if you start to see a sell-off in stocks, does that then accelerate the bid into bonds, accelerate the bid into dollars? You're 100% right that this is all going to shake out in a second. I still have my eye on dollar yen, though, and I still have my eye on the FX space, because I think it's fascinating that even in the space of that, you're seeing strength in euro dollar right now. You've seen strength in cable off the back of a worldwide market panic. Absolutely. Okay. The Pulse is coming up next. Francine is going to be taking you through the next hour. You are at the top of the hour going to get pricing on Nvidia, Apple, post the Buffett selling. All of that is coming up. We're going to continue to monitor what has already been a turbulent morning and is likely to continue to be as we count down to the US Open. So some fascinating moves in the next few minutes. Francine is going to take you through all of that. The Pulse is coming up next. It's been a busy morning. Thanks for watching. This is Bloomberg.